Real estate's 2026 time bomb is about to detonate. There's a massive bill coming due for the American economy, and it has a lot of people worried. It's like the entire commercial property market has a giant credit card, and the 0% introductory APR is about to expire all at once. We're talking about a maturity wall of debt, and the clock is ticking. This isn't a wild guess. It's baked into the numbers. Over the next few years, a tidal wave of loans needs to be refinanced. The problem, the easy money math that made these deals work, has completely flipped. As the deadlines hit, a wave of defaults is not just possible, it's already starting. This threatens to drag down property values and could pull hundreds of smaller banks down with them. The warning signs are flashing. In January 2026, the delinquency rate for office loans packaged into certain securities shot up to a record 12.34%. That's a number that makes even seasoned experts sit up and pay attention. And it's a clear sign that the foundation is starting to crack. Section 1. The giant wall of debt. So what is this ticking clock everyone's talking about? In finance circles, it's called the maturity wall. Think of it like a massive logjam in a river. All these loans, like giant logs, are hurtling downstream and are scheduled to hit a narrow dam the year 2026, at roughly the same time. According to the Mortgage Bankers Association, a staggering $875 billion in commercial real estate debt is set to mature in 2026 alone. These aren't your standard 30-year home mortgages. Commercial loans are usually shorter, often with a giant balloon payment at the end. It's like paying only the interest on a huge loan for years, then suddenly being required to pay back the entire principal in one go. Many were signed between 2019 and 2021. When borrowing was cheap and interest rates were near rock bottom, property owners took on billions, assuming they'd just roll it into a new similar loan when the time came. But the game has changed. With interest rates jumping, that old 3.5% or 4% loan is now looking at a new rate of 7% or even higher. Suddenly the numbers don't work. For many property owners, the income from their buildings no longer covers the cost of the new, much more expensive debt. This isn't a minor hiccup, it's a structural problem baked into trillions of dollars of debt. And the first big payments are coming due right now. Section 2, the impossible math and the office apocalypse. This is where the problem gets real. It's not just about the debt itself, but the impossible math that now comes with it. Let's break it down. Imagine an investor bought an office building a few years back for $10 million, taking out a $7 million loan at 4% interest. The building was full, bringing in plenty of rent to cover the mortgage and turn a nice profit. Life was good. Now that loan is due, but two things have happened. First, with new rates at, say, 7.5%, the annual mortgage payment skyrockets. Second, with the rise of remote and hybrid work, more office space is empty, so the building's rental income has dropped. Suddenly, the new mortgage payment is more than the total rent the building brings in. The owner is officially losing money every month. They face a brutal choice: pour in a ton of cash to pay down the loan, sell the building for a massive loss, or, the option nobody wants, just mail the keys back to the bank. Thousands of owners are facing this exact dilemma. The office sector is the epicenter of this shakeout. While sectors like industrial real estate and data centers are doing well, office buildings are ground zero. National office vacancy rates are hovering around 18.2%, and in some formerly booming tech cities like Seattle, the vacancy rate is as high as 27%. 1 out of every 4 offices in some downtowns is dark. We're already seeing the consequences. The delinquency rate for office loans bundled into commercial mortgage-backed securities, or CMBS, hit that record 12.34%. Think of CMBS as a financial fruitcake. Banks mix hundreds of different loans together into one product for investors. The problem is the office loan ingredients are starting to go bad, and it's spoiling the whole cake. Even iconic buildings are in trouble. In Manhattan, One Worldwide Plaza, once valued at $1.7 billion in 2017, saw its appraisal value slashed by a shocking 80% to just $345 million. This isn't a minor dip, it's a collapse. Section 3, the domino effect. When landlords falter, lenders feel the pain. When one property owner defaults, it's a personal financial problem. When thousands start to default, it becomes a systemic issue. This is the part where the dominoes could start to fall, with the first in line being the small and regional banks. While Wall Street giants get the headlines, it's the smaller community and regional banks that are the financial backbone of commercial real estate. For many of these banks, these loans aren't just a part of their business, they are their business, making up a huge chunk of their lending portfolios. For the past couple of years, many lenders have been hitting the snooze button on this crisis with a strategy called extend and pretend. Instead of forcing a default, they'd simply extend the loan's deadline, kicking the can down the road into 2025 and 2026. It's like putting a fresh coat of paint on a rotting wall. It looks fine for a little while, but it doesn't fix the crumbling structure underneath. It just delayed the reckoning and made the maturity wall even bigger. Now, some lenders are realizing these properties aren't going to magically recover and are shifting from workouts toward liquidation. As banks take back properties, they may be forced to sell them at fire sale prices, creating a vicious cycle. It's like when one house on a street sells for a very low price. It instantly lowers the perceived value of every other house on that street, making it harder for the next owner to refinance. Section 4. A slow burn, not a sudden explosion. So, is this 2008 all over again? Is the entire financial system on the brink? The consensus from most analysts is, yep, probably not, at least not in the same way. Instead of a sudden financial explosion, what's far more likely is a slow burn, a painful correction that will play out over the next couple of years. Think of it less like a bomb detonating and more like a pressure cooker that's slowly, unstoppably building steam. The pain is expected to be concentrated in the weakest assets, like older, less desirable office buildings that companies are abandoning as they move to newer, high-quality spaces. There are a few things preventing a full-blown meltdown. First, not all real estate is in trouble. As mentioned, the industrial, data center, and multifamily housing sectors are still showing signs of strength. This isn't a collapse across the board. Second, new money is entering the arena. Private credit firms and wealthy investors see the chaos as a once-in-a-generation buying opportunity. They are like bargain hunters with giant safety nets, positioning themselves to catch distressed properties before they completely shatter, creating a floor for the market that didn't really exist in 2008. Finally, some banks are cautiously starting to lend again, especially for the best properties. They're being very selective, but they haven't turned off the money faucet completely. This suggests the credit crunch, while severe, might not be an absolute freeze. While we may not be heading for a 2008-style implosion, the property market is facing a serious reckoning. The fuse is the massive wall of maturing debt. The gunpowder is the impossible math of refinancing in a world of higher interest rates. The result will be a wave of defaults and a painful but necessary reset in property values, with the office sector right in the crosshairs. Experts at TREP have suggested that office delinquencies will likely remain elevated through 2026, possibly peaking in the 12% to 13% range before things start to stabilize. For the average person, the fallout is real. It could mean tighter credit from regional banks for all kinds of loans, from small businesses to car loans. It could also impact local city budgets, as falling commercial property values reduce tax revenues, affecting funds for schools and public services, and you'll see it in your own city. More empty storefronts and for-lease signs transforming our downtowns. The slow burn has already begun, and the heat is definitely being turned up. This is a story that's going to unfold for the rest of the year and beyond. What are you seeing in your city? Are downtowns feeling emptier? Let me know in the comments below. And if you want to stay ahead of the real economic trends, make sure to subscribe for more insights like this one. Settings. Make the background music finance and business. Add any subtitle. Use YouTube audio library only. Use appropriate media. Use a male, middle-aged British voice for the narrator.